Today we are looking at consolidated financial statements, the cost method, and these are for statements after the date of acquisition. For this example, we are going to be working problem 4-8 in your text and the part B. The year after acquisition, the cost method, the question is given as presented here, where we have the trial balance for Parker and its subsidiary SID. And on December 31, the two companies' trial balance are shown here, and we are required to prepare consolidated statements working papers on December 31, 2013. Now, the first thing we would do in our consolidated working papers is we're going to use this information and we're going to prepare an income statement for the two companies, a retained earnings statement, and a balance sheet. So in the first two columns, we would record our financial statements the usual way we would prepare the financial statements. For Parker Company, you would have their income statement where you start with your sales working right through to your net income. Likewise for SID, then your statement of retained earnings and your balance sheet. These constitute the first two columns in your working papers. Now, consolidated statements after acquisition, when we're using the cost method, before the elimination of the investment account, a working paper entry is made to the investment account of the parent to recognize the retained earnings of the sub of the cumulative undistributed income or loss of said company from the date of acquisition to the beginning of the current year. So we would debit the investment in said company with $5,700 and credit the beginning retained earnings of the parent company with the $5,700. That $5,700 is computed by taking the retained earnings of the SID of $29,000, subtracting $23,000, which was the retained earnings at the date of acquisition. The $29,000 is the beginning retained earnings of the current year. The $23,000 here is the retained earnings at the date of acquisition. And the difference between 29 and 23 is 6. That is multiplied by the 95% interest in the company, giving us $5,700. And we make this entry to establish reciprocity. So we debit the investment in said company 57 and we credit the beginning retained earnings. So we debit on your working papers the investment in said 57 and the credit goes to the retained earnings of the Parker Company 5,700. After this, we then have to make the following working paper entries. We need to eliminate the investment in the subsidiary account. We need to eliminate intercompany dividends. We need to allocate the difference between the cost and the fair value. And we then would eliminate all other interests, and we would consolidate the totals by clearly showing the non-controlling interest share of income and net assets on separate lines. So let us start by eliminating the investment in the subsidiary account. Now, we would debit the common stock of the sub $120,000. We would debit other contributed capital $10,000. We debit the retained earnings with the $29,000 to eliminate the beginning retained earnings. This is made in the retained earnings statement. We would debit the difference between the implied and book value, which we would have calculated to be $15,421. The non-controlling interest in equity is now $8,721, and the investment account is now $165,700. That represents the beginning retained earnings of, the beginning investment account of $160,000 plus the $5,700, which is the company's share of undistributed profits since acquisition. Now let us just spend a few seconds looking at how we calculated this 8721. Now remember, your net assets would have comprised 120 in common stock of the sub, 10 in other contributed capital. The retained earnings, the beginning retained earnings of the sub was 29,000, and the difference between the book value and the fair value of the net assets was 15,421. When we total these and multiply by the 5%, which is the non-controlling interest, the result is the $8,721 in minority interest or non-controlling interest. So that is how we calculated the 8,721 as shown here in the journal entry. We will now go to the working papers and we would make those entries. So we have the credit to the investment account of 165,700, the 160,000 plus the 5,700. The difference between the cost and the book value is 15,421. The 120 here for the other contributed capital to eliminate this 120. This 10 other contributed capital is also eliminated, and the non-controlling interest of 8721 is recorded here as a credit, and we carry this total over to the non-controlling interest column, which is basically a working column in this worksheet. Having completed the elimination of the investment in subsidiary account, we then move to the next step. So the 29,000 you note here would have reflected our elimination of the 29,000 in the subsidiaries account. Now, we are now going to look at the elimination of the intercompany dividends. So we would debit the dividend income, 19,000, which represents our share of the net income, and the dividends declared of the sub of 19,000. We then allocate the difference between the implied book value to the goodwill account unless it is stated otherwise. If you're told that it is to be allocated to land, that is where this would go. So on the worksheet, we will make the dividend income 19,000, as you would note here, to eliminate this. And this, then we look at the sub. Now the subsidiary, which is said company, paid dividends of 20,000, and we eliminate 19. The other 1,000 represents the NCI share of the dividend, 5% of $20,000. We will also now look at the difference between the book value of 15,421. This is now eliminated, and that is allocated to the goodwill. Now the final, we would simply do the consolidated statements by totaling. We total our sales, we eliminated our dividend income, we get total revenue of 360, cost of goods sold is total here. Now, what you would have noticed is the net income of 50,000, we would have calculated 5% of this, and that is the NCI share of $2,500. That is deducted from the net income, so that we have the net income now going of 102,500. So we will total this entire columns, all the columns here, 74, 50, 19, 25, 102, and this is then transferred here in the retained earnings statement. We will then make our necessary entries here, and then your retained earnings statement balance here is transferred to your balance sheet here, and we make all our necessary totals, and we are able to balance our balance sheet at 539,921. So this represents how we would consolidate financial statements after the date of acquisition using the cost method.